time is of the essence. There's no time like the present. Time flies when you're having fun. I could go on, but you get the point. The option strategy we're going to break down today is centered around, you guessed it, time. And it's easy to remember too, since it alludes to this in its name. It's commonly called a calendar spread, but also goes by horizontal spread and time spread. If you're unfamiliar with what an option spread is or how options work, watch our introductory lessons on options or join a masterclass. But if you're up to speed, then let's continue. A calendar spread is a market-neutral strategy. It could be used when a trader expects the underlying security to trade sideways in the short term. Calendar spread traders want the underlying to trade right at the strike price when the short option leg expires. They also don't want volatility to fall after the trade is placed. This is so the long option can have as much extrinsic value as possible. Calendar spreads are traded for a net debit. As long as the spread is intact, their maximum risk is limited to the net debit paid. Lastly, calendar spreads provide traders with flexibility. They can construct them to be potentially profitable when the underlying rises, falls, or doesn't move at all. Like most spreads, a calendar spread consists of two legs of the same type of option, either calls or puts. One leg is bought and the other leg is sold. The strike price for each leg is the same. The expiration dates, on the other hand, are different. The option that's bought will usually have an expiration date later than the option that's sold. In options lingo, it's usually referred to going short the front month and going long the back month. Since the option premium is always higher with more time to expiration, the spread is traded for a net debit. Let's look at an example. An option trader named Jack buys a call on ABC One Corp shares with a strike price of $50 that expires in 180 days. This leg is called the back month, and in this case, it costs $6. At the same time, he sells a call with a strike price of $50 that expires in 30 days. This leg is called the front month, and here its premium is $2. So it costs Jack a net debit of $4 or $400 total for the trade. Pretty straightforward so far, right? Like other option spreads traded for a debit, the maximum risk is simply the $400 Jack paid to purchase it. This occurs if the underlying moves far away from the strike price in either direction, so that both options expire worthless or are exercised. Stick with me now, as the profit and risk for this trade is where things can get a little tricky. With a calendar spread, a trader will only learn how much they'll gain or lose from the strategy when the short leg of the trade expires. Because this takes place in the future, the precise maximum profit is hard to estimate. Volatility will play an important part in determining the long option's value in the future, and that's something we can't accurately predict. However, we do know at what price the stock needs to be trading for the spread to reach its maximum profit. The most positive outcome for Jack's trade occurs if the stock closes exactly at the strike price of $50 when the short leg expires in 30 days. In that scenario, the $50 call that Jack sold will expire worthless with its full premium collected, and he'll be long a $50 call with 150 days left until expiration. At that point, Jack can sell the long call to capture his profit, or he can continue to hold it if he's bullish on ABC One Corp stock. So that's the first tricky element of a calendar spread sorted out. But there's one more to deal with, and it involves break-even points. And yes, you heard that right. I said points, because there are two break-even points in a calendar spread, one on each side of the strike price. Just like the maximum profit, the break-even points can't be determined when the trade is placed. We don't know what the volatility will be when the front month leg expires. But what we do know is how much Jack paid for this calendar spread, a net debit of $4. So, the break-even point below the strike price occurs when the short option expires worthless and the long option can be sold for the initial debit paid of $4. Meanwhile, the break-even point above the strike price occurs when the short option is in the money and the price difference between the two options is enough so that they could be sold for a total credit of $4. Still with me? Phew. Now that we've settled that, let's recap why a trader would want to buy a calendar spread. Typically, a trader who buys a calendar spread wants the underlying to trade right at the strike price when the short option expires. They also want volatility to hold steady or climb after the trade is placed. This is so the long option can have as much extrinsic value as possible. Remember, time value erodes faster as we get closer to the option's expiration, mainly because volatility has less of an impact. Think of time as a stream, and the time value of the option legs as rocks in the stream. The water isn't flowing as fast upstream where we bought our long option, so the rocks erode slowly. But the water flows faster downstream where we sold our short option, so the rocks erode faster. A calendar spread is generally considered a market neutral strategy because it's most profitable when the underlying trades at the strike price is selected. But it can be used as a directional trade as well. For example, a bearish calendar spread can be constructed using puts and a strike price that's below the underlying's current value. And a bullish calendar spread can be made up of calls and a strike price that's above the underlying's current price. Essentially, the strategy aims to pin the underlying price at a specific dollar amount. However, if a spread trader is looking to place a directional trade and wants to minimize their exposure to changes in volatility over time, a vertical spread is often more appropriate. To learn more about different types of vertical spreads, check out our lessons on buying and selling call and put spreads. With all that said, let's recap the key takeaways for calendar spreads. A calendar spread trader wants the underlying to be at the strike price when the short option expires. They also don't want volatility to fall. Their maximum risk is the debit paid. Their maximum profit is unknown, and it only occurs when the underlying trades exactly at the strike price when the short option expires. There are 2 break-even points, one on either side of the strike price, and their exact values are also unknown. Traders can sometimes focus too much on trying to profit from stock prices rising and falling. Calendar spreads allow them to shift their focus to time value instead, and more specifically, changes in volatility. Speaking of time, I'm late for another video, so I've got to run. But make sure to watch our other lessons on buying and selling option spreads, when you have the time, of course.